Good evening, ladies and gentlemen. Thank you all for joining us early tonight. Welcome to a Lunar New Year special edition of the Personal Finance 101 session. Tonight, you'll find out some of the ways for you to better help your children manage their AngPao monies and even ways to invest them to generate future investment income and AngPaos. From across our iFast network, we have three speakers tonight who will share the insight with us on this topic. First up, we have Bernard Chan, Director of Investment Advisory at iFast Global Markets, who will approach the topic from a financial planning perspective, covering the different aspects parents should take note of when managing finances related to their children and especially their AngPao monies. Bernard is a father of 3 teenagers, and as a result of his wide range of experiences, he sometimes wears the hat as a parental coach, a family mentor, or even as a grief counselor. Following that, we also have Florence Tan from Eastspring Investments Singapore, who will be sharing more about their views on money and parenting, while providing an outlook of the markets and the product types which investors could consider. Florence is the head of investment marketing at Eastspring Investments and works with investment teams across the region to create insightful content. She's passionate about empowering investors, and she and the team are always looking for creative ways to make investor education uncomplicated and engaging. Lastly, we'll have our stocks and ETFs research manager, Yo Wei-Ren, who will be on hand to share with us what are some of the investment approaches and asset classes that investors could leverage on to generate investment income as AngPaos for both themselves and their children. Wei-Ren currently heads the stocks and ETFs research team, providing analysis and research coverage on companies listed on the US, Singapore, and Hong Kong stock markets. He is also part of the portfolio management team that oversees the firm's discretionary portfolios. So all this coming up tonight, and without further ado, let's kick off the session with Bernard.
Hi, thank you everyone for coming on so on time. So we are starting with the first topic on managing your children's AngPao money. And I'm Bernard. I'm the team director for investment advisory. Of course, not all of us over here are parents. Some of you may be and may be looking at how to manage your children's money. But I would just like to let you know, whatever I'm sharing over here will be very applicable for ourselves as well. Okay, so look at this money may not just be for your children. Maybe if it's for yourself, you may be in your 30s, 40s. So let's look at it from a generic viewpoint. But of course, whatever example I'm going to share will be shared from the family perspective. Of course, in these few years, I've always been sharing across with families, especially the higher net worth families. And a lot of time when some of the issues crops up, they start coming back over to me to consult regarding how to manage money, how to manage the whole family office. And of course, recently I took up some speaking opportunities over in schools as well. So later, I'm sure along the way, throughout this whole session, you guys may have questions. Do type them into the question box, and we will come back together as a panel to be answering it at the end of the sessions. Okay. So what I'm going to share later is will be a lot about how I work with families and what are the investment methodology or even financial and wealth management methodology that they work through with their families. And maybe some of y'all may have questions and say, hey, but that's we may or may not be a high net worth family. Why should we need wealth advisory or even wealth management? My answer over to you might be wealth management is required not only for the high net worth, not only for the ultra high net worth. In fact, in many years back when I started in the whole industry, we are all correct. Only the ultra high net worth or even the high net worth have access to all these services. But over in the last 3 years, while we've been running iFast Global Markets, we've been allowing, opening up this whole access of our wealth advisory across over to mass affluence, over to white collars. And today I will share a few things from the family point of view that might be important for us to be sharing across your families, especially if you have children, maybe it might be niece and nephew. Okay, I'm going to share from a very short, very simple viewpoint, and then within all these points, within these four points, I'm going to explore in depth, and you will hear a lot more later. And do share questions on the chat. Okay, so as per all internet-based and even online articles, if it's too long, you didn't read, never mind. Let me share with you the key points over here. So if you are starting to manage your child's angpao money, yeah, some may be from the lows of a few hundreds or maybe 100 plus, especially this year that we did not go around visiting as much. Yeah, I have heard some families whereby their children's angpao money goes in the range of 1,000 plus to a few $1,000s. In one very special case, I actually had one child who had the angpao money with a 5-digit numbers. So that was the year whereby the child was born and the grandparents were really, really generous. Okay. Maybe so how would all these families be managing their money? And I think one of the first options that all of us can be looking at might be even be putting some money across, example, into enrichment classes. Yeah, why did I talk about this enrichment classes? I think you guys as parents, you might be thinking, doesn't the children have more than enough tuition classes, or are the tuition classes a little bit too much for them? Especially when during our era, we don't even have tuition classes at all. We might just be parents just say, just study, just go and study whatever you want. Okay. I share this is because from a lot of personal experiences across with all these family officers that I work with, many of them share with me this one key lessons that they said, actually, whatever that they have studied in degree, actually they did not even apply at all. So recently, I was talking to this family whereby they actually built the protection on the sides for the whole Suez Canal. Suez Canal is a canal that links the central parts of Asia. Their family is really, really established. And this gentleman, he actually graduated with 2 degrees. The first degree was graduated in chemistry. And the second degree, interestingly, was graduated in the social sciences. But he mentioned that at the end of the day, he didn't have a chance to use all these things that he learned over at the university. And I actually checked with him. I said, then what do you think is useful? What were the lessons that you thought was useful? He said, actually, the most useful lessons might be actually the swimming class that he went through. So that now he has a skill, and the life skill is swimming. He also mentioned, hey, maybe actually the other skill that he learns was that he learned how to cook, especially when he was overseas for 3 years when he was actually studying. He had no choice. He couldn't go anywhere else to eat, but he was forced to cook for his own dinner, his own meals. Yeah, so actually I would really encourage, if for parents out here, if you have a little bit of angpao money and you're thinking about where to put, maybe try to expose your child over to something a little bit different. Anything more than just math, science, abacus class. I will assure you, they have a lot of such abacus class and math class over in school. But other life skills, like even playing tennis and being able to socialize and getting to know people over such enrichment class, can make quite a big difference across over with them. Okay, so the first thing that maybe you can think about using the AngPao money might be really to enrich your child's life. Yeah. The other part, the second part, I think coming back over to our finances, might be thinking, wow, if my child has a few hundreds to even a few $1,000s, or even to the high of what I mentioned, a 5-figure sum, then why don't we invest the sum? I totally agree across with this. Of course, this is our pet topic within iFast. I will not talk too much about investments because later I have my colleague, we're going to share more about how to allocate money across different investment class. Of course, for myself, my primary job is to investment advisory, but I will leave this over to my colleague to share more about this. The other thing that you can be looking at will be actually saving up that sum. Yeah, this part will be very important, especially if your child is generally maybe starting from 4, 5 years old, where he's able to converse very, very well. That is the age. Sometimes just passing that 2 years old, where many parents will be talking about this thing called a terrible 2. That's where they will scream, shout. I've gone through that. I have 3 kids, 3 children. My oldest one is already 17 years old. Yeah, and just passing the age of 3 to 4, where they are more sensible, I would really encourage you guys to be looking at saving that angpao money. And the saving effort might be a conscious effort that not only the parents are actually participating in, but actually maybe the child can be participating in this saving part as well. And again, it may not just be an act of saving, but rather a lot of time when we are saving this angpao money and keeping it for the rainy day, we are actually teaching them quite a few skills and a few life skills. Of course, life skills about being prudent, about being thrifty, and of course, not to be extravagant. Yeah, maybe let's take a deeper look down into savings. What are actually the forms of savings available? I think if I do a poll across over here, checking if everyone, you understand saving quite a few. There's one which should be very clear, very easy to be looking at. Will be actually saving into a bank account. Okay, so what's a bank account? That would be something like a savings account. And today, I think the savings account interest has really dropped drastically. My last check was that a savings account interest will be generally around the region of 0.01%. That's around 1 basis point. Yeah, that's really low. Yeah, so will we really be saving our money across in the savings account? This really depends. Let me share what's the advantage of savings account. One of the key advantages is that there's flexibility and there's liquidity. Liquidity meaning if you suddenly need to use money, actually the cash balance is available and there's no tying, there's no lockdown. So this is one of the key advantage. But beyond that, actually a savings account might have other limitations. Like example, money is getting, or other things are getting more and more expensive over the years, which means the buying power of money is getting lower and lower. Of course, the technical term here is something that all of us might be familiar with. The technical term is called inflation. So which means actually savings account, a lot of time is not able to offset inflation. But one key advantage is the flexibility and the liquidity available. The other way to save, which I think some of us over here will be very familiar with, especially when we talk to our more senior relatives, like maybe to our parents, to our grandparents, or even to the more senior folks around. A lot of time they may say, instead of savings account, why don't we put our money into fixed deposits? Then at least the fixed deposit rate is higher. That's wonderful. Of course, over the years, fixed deposit rate has been dropping. I used to see years whereby it was 5%, dropping down to 3%. And to today terms, fixed deposit rates can be as low as January 0.3%. And recently, I was looking at the meeting report of the place that I stay in. They were asking, doing a survey across to say, should we renew the fixed deposit rates for the endowment fund in the place that we stay in? And the rate given by one of the bank, and they say it's the highest rate already. The rate was only 0.32% for a 6-month fixed deposit. Okay, so over the years, actually, deposit rate has been dropping. And fixed deposit, again, their interest rate, the advantage is that the interest rate is slightly higher than the savings account, but you may have your sum lock up for a short period of time. And of course, this is a predetermined time slot. So the first two are actually traditional instruments available. And while I'm sharing some of those points across over with all of us, all this can be information that parents over here can sometimes take pieces of small little information and share that with your teenage children. And I will assure you, this is actually wonderful information to share across with them, because schools teach us arithmetic. School will teach us plus, minus, divide. Schools will teach us a lot of maybe even complex math terms, like trigonometry, sine, cosine, tangents, or even calculus, like differentiations and integrations. But a lot of times, school may not be teaching your child financial knowledge and financial literacy. And the next 2 points I'm going to share about will be financial details that you can teach your child. So over here, savings. The other way of saving might be by putting some of the money into bonds. So what is bond? Bonds are actually a loan, and a loan to any institutions. It can be a loan over to government, it can be a loan to a company, or even to other financial institution. And because you I use the term investor, you are loaning your money over to, example, a company. The company will promise you a certain return, just like an interest back over to you. And of course, this interest, the technical term is called coupons. They'll be issuing coupons over to you on a fixed basis, normally on 6 months, sometimes on a yearly basis. Okay, so that's what bonds are. And I will encourage you, if you're looking at a little bit of returns, yeah, do consider putting some of your child's AngPao money across into bonds rather than just using traditional savings account and fixed deposits. Why so? Because bonds are a lot of time a fairly low risk instruments, and yet the return generally can be the range of 2 to 3%. Sometimes if you use a higher risk bonds, yeah, it can actually go up, or something called high yield bonds can go up around to the 4%. Sometimes actually there are 5% bonds available as well. Of course, that's where the risk gets a little bit higher over time. Okay, so do consider using bonds as an instrument to save. Yeah, maybe from here I will ask, hey, what's the next thing that you can use to save? Maybe you may be thinking using stocks. No, I'm not going to talk about stocks because that might be moving into or rather equities. Equities will be moving into investment arena, and later I think my colleague will be sharing more about using equities. Yeah, I want to share with you another possible instrument that can be used to be saving. And this part will be using some form of cash solutions available in different securities firms. And I will encourage some of the parents over here to consider this as well. Not only saving for your child, that will be saving for yourself. And why using such instruments is that a lot of times such instruments are very transparent, and the risk is also generally low risk. So I give some very simple example. One of the cash solution available, like cash accounts or auto sweeps accounts, there are generally minimal lag time, and actually a lot of time is a little bit different from like fixed deposits. There are no lockdown, and generally there will be no penalty available. Okay, and maybe one of the very simple example would be one of the tools that we have available within some of our FSM and IFAS accounts. The auto sweep account will give yield of around 0.6% per year right now. Okay, then there is also another form of savings instruments that might be available. I think right now, because of COVID, you may see less of these things, but pre-COVID timing, you will see road shows around. And a lot of time when you see road shows, you will see generally financial salespeople promoting savings instrument and savings tools. And a lot of time, these tools are called endowment plans. And I would really encourage you guys that all of us over here, endowment policies useful. It is. I use it for myself as well. I use it for my child as well. Yeah, but be an intelligent investor. If you are choosing some level of endowment plans, I would encourage you to look out not for pure endowment plans, but look out for anticipated endowment plans. And let me show you what is this difference. What is an anticipated endowment plan? The normal endowment plan will be, let's say today I decide to save maybe $300 every month, yeah, through the plans. And after 20 years, I will get the fixed amount over here. So firstly, a few things to run through with everyone, that endowment plans are not investment based. That means if you want to grow your money, this is definitely not the tool for you. Do not use this. Yeah, this is only a tool useful if we are, let's say today I want to say that my child may enter university at 20 years old. 20 years later, I want a fixed amount of money over here. Yeah, this will be very useful if I have a fixed target and fixed timeline. Later, I will tell you about one very interesting option that you can use that will help you in this anticipated endowment plan. So what is anticipated endowment? What it is will be, instead of your money being locked up all the way through like a fixed deposit, anticipated endowment actually has coupons available. Yeah, and these coupons can start as early from the third year. So that, and the reason why I think this is important is because this will allow you to have flexibility and have cash flow and liquidity. Yeah. Then the other part that I mentioned, what is the use of such endowment plans? Yeah, the main use for it might really be when, let's say, from now until 20 years in between, yeah, the parents or the caregiver has some contingency issue. And this contingency issue can be because when you're critically ill, you're disabled, or even sometimes you as a parent pass on now. Yeah, which means suddenly we cannot save anymore. But the important part is that this amount that we have planned for your child will still be available across over to him or to her. Okay, so this is one of the important parts. So important thing that I want to share is that, of course, if you do meet financial salespeople, important to be very critical and to be asking a lot of questions. And of course, just to let you know, because our specialization is not in insurance, so a lot of time we come into, we will advise, we will consult whichever area that you need help with, but we also want to make sure that, let's say if we receive any commissions, we'll actually refund a portion or rebate a portion of all these commissions backward over to you, up to generally a maximum of 6 years or when the commission ends. Okay, so that's the part of the savings. Yeah, remember just now I had 4 parts over here. Yeah, and the other part that I want to share a little bit about will be some parents will decide to, let's say, I want to park some of my child's money across over in insurance, so I can actually build an education fund across for him or her, maybe for a marriage or maybe as a head start protection across for the child. I just want to share a few key things over here. Maybe all this insurance, a lot of time they are actually overly complex instruments. And the important part is that you must be able to break down some of all these points. And once you're able to break it down, you will start to understand it better, and then you will want to make a better decisions. Because a lot of times such instruments and products are very long-term product. It can be as long as paying for a lifetime. And you want to just make sure that you are not putting too much money and then having some regrets later. So I want to use a few examples, a very quick example. Yeah, for parents over here, you might be aware and you know that there's such thing called maternity insurance. Yeah, a lot of time when parents, when they attend any children baby fair, there's a lot of promotion, and a lot of time all this maternity insurance will bundle together with it, investment link plan or a whole life plans. Something that you may not be aware of is that actually, yeah, it need not be bundled. All these things can be broken up, and when it's being broken up, that will make sure that the maternity insurance is so much more cheaper compared to a bundling up. So I do encourage you guys that if there's a need, if you're looking at maybe something along these directions, make it cheaper. Yeah, breaking it out. There are also other pricing mechanisms over here. Is that all this insurance, actually there may not be a need to pay one lump sum all the way through, or even to be paying every year. A lot of time it can be broken up into, example, the first 10 year, the second 10 year, the third 10 year. Yeah, because when we start, maybe we are at 35 years old. When we are 35 years old, the risk that we have, risk meaning the chance that we may, example, have a critical illness is very low, which means that our premium can be much cheaper. Okay, so there are some ways to break it down so that actually things will become cheaper and very much more affordable. Okay, so of course I have shared all the 4 points over here, things that we can be doing with our child's AngPao money. Are there other things that we can do? I'm going to throw in a small bonus over here. Bonus, something that I do share with some families and I do work across with them. This is my pet topic. Maybe I share a small story across with you, and then you understand why I want to share this bonus point across with you. There's one family that I've been consulting with for the last at least the last 15 years. And actually they have their oldest child is a boy. This boy is 16 years old this year, turning 17. And I've actually seen the whole process. I've actually walked through the whole process across with this family, seeing that child growing up. And that child just finished his O-levels last year, collected his exam papers this year. And when he was doing his O-level last year, he called me Uncle Bernard. So he came over and said, hey, Uncle Bernard, I want to apply for direct admissions over to Singapore Poly into the business program. He said, hey, you want to apply, but he's concerned that his O-level may not be as good. He told me that his result is not as good. So I said, go and apply first. And in the application, he asked me to look through what he was writing to send over to Singapore Poly. So when I read through, there was one part that I was quite surprised, that he wrote this story about what he does with his parents every Sunday. Of course, the good news is he was directly admitted into Singapore Poly, And he didn't even need to, his O-level result was not even important anymore, because he got his admission into Singapore Poly business stream even before the O-level exams are. But let me tell you that very important part of the story, which is what did he write in this application form? He wrote there, he said that I want to study in SP business because I want to be using my business skills to be helping other people. Then he said, why does he want to help other people? Was because ever since young, every Sunday, he'll be going over to church with the parents. And ever since he ever knew, he ever could understand things, every Sunday morning when they walk out from the church compound, there'll be one uncle selling tissue paper on the side over at City Hall MRT. And the father will always give him $1 and ask him to go and buy tissue paper. And this 16-year-old boy, he shared this part that I want to use the business skills that I learned to help to make things better for the community, including even that uncle selling tissue paper over there. When I read that, I was touched, and I thought it was wonderful that he wrote that. And of course, when the lecturers over in SP read that, after that interview, he was admitted directly into SP even without his O-level results. And I shared that is because actually a lot of time, are we just keen to be growing our money? Are we just keen to make sure our money grow a lot? Or do you want to use small little chance and opportunities to be sharing with our child as well, our niece and nephew, about the possibility that it's not only just about investing money to grow it for ourselves, but a lot of time we can invest for goods. Okay, so think a little bit about it, parents and even uncle aunties over here with niece and nephews. You might want to even encourage. So this year there was an interesting campaign by NVPC. NVPC is the National Volunteer and Philanthropy Center. They suggested this part. Why don't we gift, as a present, give our AngPao over to people who need it a lot more? And of course, our NVPC is a national level organizations. They have a platform called giving.sg to give money across. Yeah, maybe you might be thinking, hey, we may or may not want to give away our money. Then I would suggest maybe the other possibility. Let's look at the other option whereby we can really be using the AngPao money in a meaningful way with our children, but we use it in a way whereby it does not eat into our capital. And what is it? There are actually a lot of social enterprises around within Singapore. Many of them are, I give some examples, like there are social enterprise who are F&B, who are restaurants. Yeah. And what is a social enterprise? A social enterprise is a place that maybe while they're doing a business, there is a strong social cause helping the community. Like example, there's a restaurant that I always go by that they train and employ special needs individual, people who are intellectually challenged or maybe who may be autistic. So actually, instead of just giving your money away, and so I give some example, like this weekend, you intend to bring the family out for a simple dinner at a restaurant. Maybe that dinner may cost $15 per person. Instead of spending the $15 over in a normal restaurant, why don't you spend your $15 over in a social enterprise restaurant? It's still $15. You may still get your own meal, but in that process, you might be teaching your child a very different lessons. It might even be a life lessons. It might be just as simple as my client who gives that $1 every week over to the child to buy a packet of tissue. Okay, so this is just the last bonus point that I thought I want to share across with all of you guys. Investment may not just be for ourselves, but a lot of time it can be done across with the community as well. So I know you may have some questions. I will encourage you guys to list your questions over in the question box. Or if not, you can just email it over to us at the email address over here. I will still be staying around all the way through until the last speaker finishes to take your question. Okay, thank you. So I hand over to the next speaker right now.
I just want to say good evening to all who have joined, and a big thank you also to IFAS, Fund Supermart, for giving me this opportunity to share with you Eastspring's view and about Eastspring's money parenting project. Okay, so I've got the slides now. I'm going to share screen. Okay. Now, so eSpring conducted a money parenting project late last year. And what is money parenting? So money parenting in a nutshell is about talking to your children about money issues, helping them understand the responsibilities that come with money, and basically, imparting your values on money to them. And so you might say, why would eSpring do such a money parenting project? And that's because, besides being an asset manager, and being very focused on investing, we are also very focused on the community that we operate in, and children and parents review are very much part of that community. So as part of the project, we actually surveyed 10,000 parents across 9 Asian markets. And we wanted to understand how parents across Asia were speaking to their children about money, and what different styles they were, and what pain points parents had. And this, we believe, was one of the largest survey of its kind across Asia. And right now I'm going to show you a 30-second video on a very interesting social experiment video, which we did as part of this project. So as part of eSpring's money parenting project, what we did was we brought children and parents into a room. And earlier we had given instructions to parents on how to open this mystery box. Some bizarre instructions like throw confetti, wave a wand. And so the parents did that. And after that, they left the room. And then we asked the kids, to open the box. And that was all we said, just open the box. And interestingly enough, the kids just followed exactly what the parents did. And so I love that story which Bernard shared just now, where the boy was clearly, his money values was clearly shaped by what his parent or what his father taught him. And so we are role models for our kids, not just in all sense, in every sense, and especially on money. And which is why we are very passionate about this subject, and which is why eSpring's Money Parenting Initiative is focused on parents, because we want to help parents on that money parenting journey. So in Singapore, we surveyed 1,000 parents split across fathers and mothers, so we were very fair. And these are some of the results that we found. We found that almost all of us agreed that talking to our children about money was very important. And more than half of us, provided guidance and very clear advice. In fact, on top of that, another 20% of parents said that they actually gave very strict or had very strict control over how their kids spent money. And yet, despite this guidance and clear advice, when we asked parents in the survey, how confident did you feel? Did you feel like you were doing a good job? Only 29% actually indicated that they felt they were doing a good job. And at the same time, what was also interesting in Singapore is that we start talking to our children much earlier than the region, so as young as 5 to 6, and we suspect that we are prepping them for primary 1 when they start getting that pocket money to go to spend in a tuck shop and in the bookshop. And parents in Singapore, more so than across the region, tend to act and behave like a team when they talk to their children about money. So it's in some households, yes, there will be the bad cop and the good cop, but very much in Singapore, we found out, at least according to our survey, that a lot of the parents acted as a team. And the top 3 reasons why parents wanted to talk to their children about money. And the first was that they hoped that by teaching them money lessons, good money lessons, when the children grew up, they could be 1, financially independent, and 2, have a head start in life, and 3, something I think very close to a lot of our hearts, managing their money so well that they can be able to buy property. Now, at the same time, as part of this initiative, we created a money parenting survey, a sort of persona quiz, and you get a chance to do that quiz later. And it's just a very short quiz, a 2-minute quiz, and it actually tells you what sort of money parenting persona you are. We found there were actually about 5 main types of money parenting persona. There is no one right persona, and very often personas are formed or created as a result of your beliefs, your personality, sometimes cultural reasons, sometimes religious reasons. And so these are the different personas. And when we surveyed parents across Asia, they said that, no, yes, while I have a parenting style, I'm also interested to find out, what other parents are saying to their kids and how other parents money parent their kids, which is why we have come up with these personas. So for example, the go-getter parent is one that's likely to say, I want to give as much information to my child as soon as possible and in many different ways. So the go-getter parent is a very proactive parent. So the go-getter parent will talk about money to children at every opportunity that they can find. So whether they're in a supermarket or they're in online shopping or in the, for example, in the toy shop. So they'll impart money values. They are very open to explore, to play games with their kids, maybe attend a workshop, listen to a webinar, to find out more ways that they can improve and help them on that money parenting journey. And from the survey, we also found out that the go-getter parent are most likely to expose their children to investments. Now, perhaps on the other end of the spectrum, we have the freestyler parent. So the freestyler parent is all about leave it and let them learn through experience. So they are not going to meddle. They feel that a lot of this advice and guidance could be seen as interfering. So the freestyler parent is most likely to encourage their child to take on a part-time job, for example, to learn how to make money and then learn how to spend that money. So they are least likely to tell their child how to manage finances. And we also found out that they are also then least likely to actually purchase investments for their children. So now I hope I've piqued your interest and you are dying to know what sort of money parenting persona you are. And that's the QR code there. You can actually just use your handphone right now, do that 2-minute quiz, and you will know what sort of money parenting persona you are. And as a result of the different money parenting personas, eSpring has created a lot of content actually to help different money parenting personas. And even if you don't want to know your money parenting persona, we actually have a lot of content to help you depending on how old your child is. So I'll just move to the next screen just to show that's the money parenting site on the eSpring Singapore website. So lots of free content, lots of resources for parents. And at the same time, we did a separate poll and we asked Singapore parents, what is the one thing you wished your parents taught you, when you were growing up? And interestingly, and very much according to what Bernard said just now also when he shared, a lot of the parents said to us, 64% actually said to us, I wished my parents taught me how to invest or taught me about investing. And so this on your right, you can see is the greenhouse site on the eSpring Singapore website. And again, it is a treasure trove of investor education content for us. So if you have older kids, and we have shared this content with one of the polytechnics in Singapore, and the students have found it very useful. So there's a lot of infographics, videos, frequently asked questions about investing, not just on ESG, but across all asset classes. So if you have older kids, or if you are yourself still on a learning journey about wanting to know more about investments, about ESG, what does it mean, do come to this site as well and explore and just benefit from the content that is there. Now, a lot of parents then ask us, is there a way to marry the persona that I am with the sort of investments that I should be doing? And yes, before I do that and move on to that, perhaps I just want to share with you very quickly Eastspring's view of the market. So if we take a step back and look at how markets have performed last year, and despite the economic contractions that we saw across most of the world last year, it's been a great year for risk assets. And you can see that because of the very low interest rates and the stimulus that was in the markets, the equity markets performed very well, led by the North Asian markets. And then even the bond markets also did really well and delivered positive returns. A key laggard was oil, which underperformed because prices fell as economic activity contracted. Now, if we fast forward year to date, and this is what the market has done as of last Friday, and you can see that oil has staged a rebound, and that's partly due to the optimism that the economic activity is going to pick up this year. But still, at the same time, equity markets are doing very well, especially in Asia. Now, given how much markets have ran last year and this year, it is very natural for investors to ask, are markets getting too expensive? Are equity markets getting too expensive? So we asked our multi-asset team, also known as the Eastspring Portfolio Advisors team, and they shared with us one indicator that they use to see how expensive markets are, and that's that gray line on your left. And that is a composite indicator, so they combine two valuation measures, price to earnings and price to book. And you can see that, yes, while valuations clearly are a lot more expensive than they were at the start of last year, for example, but still not at levels the team feels that should be worrying yet, as long as there are other positive drivers in the market. And some of these positive drivers, for example, is earnings. And you can see on the red line on the right that earnings are continuing to be revised up. And so that is positive for equities. At the same time, we believe that fiscal and monetary policies will remain very supportive of markets. For just example, in the US, for example, if you look at the chart on the left, given that there is a Democratic sweep in the White House and in the Senate, the US is expecting to see a lot more stimulus than they would under other scenarios. And so that bodes well for the cyclical recovery in the US. And so we do expect, as the vaccinations have gone on a sort of rocky start, but we do think that vaccination programs will improve and accelerate. We do expect to see also infections, COVID infections coming down, and that should lift and help to normalize the economy, and that should lift consumer sentiment and consumer spending. So already we saw in January, the US retail sales numbers were very strong, signaling there is pent-up demand that's waiting to be unleashed. Now, a lot of investors may ask, how about inflation? There's a lot of news about how oil prices are going up, how commodity prices are going up, and the bond yields admittedly has gone up quite significantly over the last couple of weeks. And yes, inflation is one thing that we are monitoring very closely, and we do agree that inflation numbers are going to look higher in the coming months, especially in the second quarter. That's partly due to the base effect. Because last year around this time, inflation numbers were very, very depressed as economic activity shrank. So we're going to see higher inflation numbers, but I guess the question investors need to ask is whether that pickup in inflation that we're going to see, is it going to be sustained? And then the next question is the inflation levels going to be high enough to make central banks so worried that they want to lift interest rates? And we don't think so, partly because that we feel there's still quite a lot of slack in the economy. So for example, taking the US economy as an example, unemployment rate, the latest reading in the US is about 6%. And that's still quite far away from full employment, which we think is about 3 to 4% in the US. So the Fed is likely not it's not likely to want to raise rates too fast. And the Fed, besides wanting to see, yes, the US economy recover, I think they want to have some comfort that the US economy can have a sustained recovery. And so we think that interest rates are going to stay low for some time. And that's actually really important for the bond markets. And here I just want to share with you, how the Asian bond markets compare to the developed market bond markets. And you can see that this is just for the 10-year government bond yields in Asia in red, and then in gray it's the developed markets. And you can see the yield pickup that Asia offers. So this is just government bond yields, and the case is the same across high yield bonds as well as across investment grade bonds. And then coupled with, quite a positive macro backdrop in Asia in terms of the recovery, explains why, we have seen quite a lot of inflows coming into Asian bond markets. Now, some of the themes we think that while we have a relatively positive view of the equity market, some of the themes that we think that investors might want to consider long term, whether it's for themselves or for their children's AngPao, is to some have exposure to technology. We think that's something here to stay. And here, this chart just shows one example of a big phenomenon, which is e-commerce. So Asia is actually the world's largest e-commerce market. And if you have been buying on Shopee or Lazada, that's you contributing to the red bars there. And the e-commerce market in Asia is expected to continue to grow exponentially. So our managers are looking for opportunities to tap into that. And not just on direct e-commerce players, our managers are looking at how technology as a whole is impacting other sectors. So for example, like our multi-asset Asian real estate team. So what they're looking at is that, e-commerce, because of e-commerce, there is a great demand for warehousing. And so they are looking at players that have good exposure to last mile assets, to industrial space in strategic markets. And because there's a lot of data also being generated from e-commerce players, and also a lot of data generated in general due to the technology explosion, whether from 5G or AI, there's a lot of demand for data centers, especially in China. So that's another area of growth where our managers of the Asian multi-asset real estate solution team is looking at. And so it's interesting to see that, while COVID-19 may have lent some uncertainty to certain sectors of Asian real estate, like offices and retail malls, there are new opportunities emerging as well, which our managers are tapping on. Now, another key theme that we would think investors, whether it's AngPao money again or long-term money, should look at is ESG. Now, there's been a lot of research to suggest that Asia is going to be one of the most hardest hit region in terms of climate impact. So we are probably going to see the harshest weather conditions, droughts, and I don't mean to make people depressed on a Tuesday evening, but clearly there's a lot of impact coming to Asia that's going to hurt productivity, agricultural yields, and GDP. And so because of this urgency, we do think that policymakers and companies are going to step up, and they're going to find solutions to mitigate the impact. And so, for example, we do think there's going to be a lot of renewable energy capacity coming into Asia. So our Asian Sustainability Bond Fund Manager, for example, is seeing a lot of new issuances coming from China and India clean energy players. They also expect to see new issuances coming from electric vehicle producers. Now, talking about electric vehicles, it's also a theme that our China A team is very much focused on. And they believe that the focus on clean energy has engendered a permanent transition to the electrification of transportation. So it's about e-mobility, so e-vehicles. But they're not just looking at e-vehicles. So the team based in China is looking at less crowded places as well to derive alpha for investors. So they're looking at components that go into batteries and parts that goes into these e-vehicle or electric cars, for example. So they do think that they see quite a lot of opportunity out there. Now, are there risks? Of course, there are risks. There are always risks to investing. And one risk out there is, of course, we get virus mutations where the vaccine loses its efficacy. So that's one thing we are also monitoring. As mentioned earlier, because our relatively bullish case is premised on very supportive fiscal policies and low interest rates. If that changes, that will also change our view of the markets. And then if we start to see a very unruly rise and very quick rise in bond yields, that could also affect what sectors and our asset allocation. Now, if I had to marry everything, so our outlook, our solutions, and the money parenting personas, this is potentially something that you can look at. Of course, we know that there's a lot of other factors that should drive your investment decision. For example, your risk appetite, your time horizon, and what you already currently hold. But these are some of the eSpring solutions that are on the platform, on the iFast platform. And maybe I'll just call out the Global Growth Equity Fund. So a lot of Asian investors, including myself, we have an Asian bias. So this is a global fund that may give you a little bit more diversification if you don't have global exposure. And it's very much exposed to some of the themes that we mentioned that we liked earlier. It's a stock picking team. So they select best of class companies. So potentially companies that would have pricing power if inflation does become a problem down the road. Another potential solution to call out, as I mentioned just now, about bond funds, and Bernard also spoke about bonds in general. And yes, there are high yield bond funds that gives you higher yields. So the Asian high yield bond market is averaging a yield of about 7% right now, significantly higher than US high yields or European high yields. Of course, that comes with a bit more volatility. And so for investors who want less volatility, so a bit more stability, a bit more income, I'll just call out right now the Singapore Select Bond Fund is rated 5-star by Morningstar, and it gives you stability, income, and also exposure, we feel, to very high quality Singapore companies. So that is basically what I have to share. And I would like to pass this time now to Wei Ren from iFast, who will share about strategies, I think, and asset classes on how to generate investment income.
Hi, good evening, everyone. Thank you so much for joining us today. My name is Wei Ren. I'm part of the research team at iFast, FSM, and I am also part of the team that helps to look after the firm's discretionary portfolios. So the topic that I will be sharing with everyone today is about how you can give yourself AngPao monies through investment. Now, investment is actually a very broad topic, so I'd like to define very clearly what I will be sharing today with everyone. So this is going to be my presentation agenda. Very specifically, I want to talk about portfolio construction, and I want to suggest to everyone a framework that you can potentially use to build a portfolio that is adequately diversified. And also after that, I will also move on to talk about how investors can potentially, what they can do to build a portfolio that can give them a regular income. And last but not least, for the investors who don't really have the knowledge, expertise, or time to build their own portfolios, I will also be suggesting a couple of solutions as well. So without further ado, I'd like to jump straight in to talk about portfolio construction. But before I do that, a word of disclaimer is that there are actually many different ways to do portfolio construction. And what I am about to share with everyone today is basically a framework that iFast adopts. And it is a framework that iFast adopts, not just for our clients, but also personally. This is also a framework that I use to construct my own investment portfolios. And I'd like to share with everyone this very simple framework that we use. Okay, it is actually a very simple 4-step process that we use to do our portfolio construction. So this actually begins with the first step, what we call an inter-asset allocation, followed by intra-asset allocation, product selection, and last but not least, we do a review and regular rebalancing of our portfolios. And over the next few slides, I just want to go through in depth each of these individual steps, what they involve, and what investors generally need to take note of at each individual step. Now, when you first build a portfolio, you usually look at the inter-asset allocation. And at this first stage, essentially what you are trying to do is you are deciding what asset classes you want to invest in, and in what proportions do you allocate to each of these individual asset classes. So the two most commonly used asset classes in most investors' portfolios today are equities and bonds, but there are also other investors out there who see gold as an asset class, and there are also investors who see cash as a unique asset class by itself, and sometimes they want to incorporate these asset classes into their portfolios. It is perfectly fine, but for the purposes of my presentation today, I will just be focusing on the two commonly used asset classes, which are equities and bonds. So for every investor, you will first need to identify the asset classes you want inside your portfolio, and you also need to decide how much of your portfolio should you allocate to each of these asset classes that you have identified. So in this case, you need to decide how much of your portfolio do you want to put into equity markets, and how much of your portfolio do you want to put into bond markets. So for investors who are more aggressive, you will definitely want to incorporate a higher level of equity exposure into your overall portfolio. And conversely, if you are a retiree, if you are an investor that is relatively conservative, then of course you want to incorporate a larger proportion of your portfolios into bonds, because in general, equities are considered higher risk compared to bonds. So if you are somewhere in the middle, then of course you can adopt a balanced portfolio approach, allocating 50% into equities and 50% into bonds. And in our overall asset allocation, we also have suggested allocations for investors who are moderately conservative and are moderately aggressive investors as well. So these percentages that you see on the screen here are suggested allocations, and they are also what we call the neutral asset allocation. Neutral asset allocation meaning that this will be the asset allocation that you will always fall back on if you don't really have a strong view of whether equities are going to do well in the next 12 months or whether bonds are going to do well in the next 12 months, then of course you will just fall back upon your neutral allocation at any one point in time. Okay, but of course, if you do have a market view, if you think that in this current market environment, if you think that over the next 12 months, equities in general are going to do relatively well compared to bonds, and you want to incorporate these market views into your asset allocation, it is also possible. You can actually make adjustments to your inter-asset allocation and incorporate all these market views into your overall investment portfolio. So how do you do that? So I'd like to use the example of the balanced portfolio that the balanced investor who runs a 50-50 allocation into equities and bonds. So if this investor thinks that equity markets are cheap, like last year, for example, after the COVID-19 sell-off, if this investor thinks that stocks are cheap and there is a very high likelihood of stocks outperforming bonds in the next 12 months, this balanced investor can actually increase his allocation, his portfolio allocation to stocks. So initially, it was a 50% allocation to stocks, but now this investor can actually increase his equity exposure up to 60%. And conversely, if this balanced investor thinks that equity markets are relatively expensive, if he is afraid of a short-term market pullback and he wants to be a bit more defensive in his market positioning, then it is also okay for this balanced investors to reduce a bit of his equity market exposure. So similarly, from the initial 50% allocation, this investor has actually reduced his equity market exposure to about 40% of his overall portfolio. Okay, so along the way, if you do have market views and you want to express these views into your inter-asset allocation, it is possible. Okay, but at this stage, I just want to stress also that at iFast, we generally do not recommend investors to make big changes to their inter-asset allocation. So if you are a balanced investor with an initial allocation of 50-50, and if you are positive on the future performance of stock market, we generally do not recommend that you go 100% into equity markets. And the reason for that is because firstly, we may be wrong. We may be wrong about the future performance of an individual asset class. And we want to make sure that if we are wrong, then our portfolios are not too negatively impacted by this wrong decision. And secondly, if you do make big changes to your overall inter-asset allocation, then you are going to materially change the risk profile of your portfolio. So from an initial balanced portfolio, if you make big changes, you could end up becoming an aggressive portfolio instead. And this will actually deviate significantly from your intended risk profile. And you may also run the risk of not meeting your financial goals. So it is important to note that if you do want to make changes, it is okay, but please do not make big changes to your asset allocation. And over at iFast, we generally recommend that investors do a maximum of about plus minus 10 to 15% from their neutral allocation. So for the balanced investor, how much can you adjust your portfolio allocation? So from the initial 50%, you can actually adjust it either upwards by 15% to 65, or you can reduce your equity exposure by 15% down to 35% exposure to equity markets. So these are just some of the ways you can adjust your inter-asset allocation to reflect your market views. So that is the first step, inter-asset allocation. So you decide what asset classes you want to invest in, and you also decide the percentages. And in the second step, you move on to do your intra-asset allocation. So at this stage, after identifying the asset classes, stocks and bonds, you essentially want to go into the asset classes and decide which equity markets you want to invest in. And within the bond asset class, which bond markets do you want to invest in? So the way we do bond market allocation is a bit different from our equity market allocation. So for bond market allocation, we aim to invest in the major bond markets around the world. And you can see from this screen over here, our suggested framework, or rather our suggested allocation for bond markets, we generally cover all the major bond markets out there in the world. And also we have a relatively balanced allocation between the safer segments of the bond market as well as the higher yielding bond markets. But generally, we see bonds as being a stabilizer in our overall investment portfolio, and we tend not to take too much risk with it, which is why in our recommended allocation for bond markets, we do have a larger allocation to the safer investment grade bond markets, which includes your Singapore-centric bonds, global bonds, as well as the Asian investment grade bonds. And this overall framework, we think it provides adequate diversification and also stability to your fixed income portfolios. Now, for stock markets, how we do our equity market allocation is we use a GDP weighted methodology. And what this methodology means is that the amount of allocation, the percentage allocation to each individual equity market is really determined by the size of the underlying economy. So for example, in this pie chart over here, the US economy as a percentage of global GDP, that percentage is about 21.5%, which is why in our overall equity market allocation, we have about a 21.5% allocation to the US equity market. And we do the same for the rest of the major equity markets, which includes Asia ex-Japan, Europe, Japan, and we also have exposure to other emerging markets like Latin America and EMEA. So we think that this framework, it actually provides a very good diversification for the investor, especially when compared to a traditional market cap weighted methodology. If you use a market cap weighted methodology, there's a very good chance that your portfolio is very skewed towards the US equity market. So by adopting the GDP weighted methodology, then of course your equity market allocation becomes more evenly spread out across all the different equity markets. And also, one thing that I'd like to highlight at this point is that this equity market allocation is not something that is static across time. At iFast, the research team actually looks at this allocation on a constant basis, and we always try to fine-tune it such that it reflects the economic realities of today. So one of the most recent changes that we have actually made to our equity market allocation is we actually carved out an allocation to the digital economy. And the reason for that is really because we think that the global economy is increasingly disrupted by digital technologies. And with COVID-19, of course, the global adoption of technologies has even accelerated. So we think that technologies are here to stay, and we also think that technology, not only does it play an important role in our everyday lives in the global economy, it also has an important role to play in our overall investment portfolio as well, which is why we see digital economy not as something that belongs in your supplementary portfolio or your satellite portfolio. We see it as something that belongs in your core equity market allocation. And this is something that we have implemented recently for our model portfolios. But of course, if this is something that you're not comfortable with, if you think that digital economy is something that is high risk, then of course, in your own equity market allocation, you can actually remove the digital economy from your overall equity market allocation. Okay, so after deciding what equity markets to invest in and what fixed income markets you want to invest in, then the next step is to select the appropriate products for all the different markets that you have identified. So what kind of products can you use? You can, of course, opt for the more diversified vehicles like unit trust and ETFs, or you can also use single securities like stocks and bonds. But for today's presentation, I will just limit the scope to just unit trusts and ETFs because they are more diversified, and I believe they are also very suitable for investors who are just starting out in their investing journey. Now, how do you choose the right products for your portfolio? So the way you choose unit trust and the way you choose ETFs for your portfolio, they should be different because these two investment products, they are very different in nature. So with unit trust, you are talking about an active strategy that seeks to outperform the markets. So when you want to choose the right unit trust, essentially you want to look at the track record of the portfolio manager. ETFs, on the other hand, they are passive vehicles. They only track the performance of an underlying index, which also means that the way you choose ETFs should be very different from the way you choose unit trust. So for unit trust, generally, we recommend our investors look at three different things: performance, expense, and also the resiliency of the fund that you are assessing. They always say performance is always not necessarily indicative of future returns, but in the case of a unit trust, in the case of an active strategy, I think performance and also the long-term track record of a fund manager is very important because you're essentially putting your money into, when you're selecting a unit trust, you're essentially selecting the fund manager. You are giving your money to the person whom you think is in the best position to help you grow the money and help you to beat the market. So performance, of course, would then be in fact, the most reliable way for us to assess the track record of a fund manager. So not only do you look at the cumulative returns of a unit trust, you must also look at the calendar year returns of the unit trust to assess the consistency of this active strategy. Expense ratio, of course, I think that's another important consideration because unit trust in general, they are more expensive in terms of the management fees compared to ETFs because unit trusts, they are made to outperform the markets. And to incentivize the fund managers to outperform, they will then, of course, charge a higher management fee. And of course, for investors, from the perspective of investors, if the expenses are too high, it actually eats into our investment returns. So expense ratio should also be part of your consideration when selecting an active strategy for a portfolio. And last but not least, I think the resiliency, the market positioning of the portfolio manager, I think that's also another thing to look at. In general, you want to see how well the fund is able to hold up during periods of market correction. So I think resiliency is also an important factor that you should consider when you are choosing an active strategy for a portfolio. Now, passive strategies, which includes your ETFs, they are different. Like I said just now, they don't seek to outperform a market. In fact, they simply just replicate the returns of an underlying index. So the way you choose the ETFs then will be very different. You essentially want to choose the ETFs that gives you the returns that is closest to the underlying index at the lowest cost. So expense ratio, again, another important consideration. Tracking difference is also another consideration because you want to select the ETF that gives you the closest return to the underlying index. So tracking difference ideally should be as low as possible. And also because ETFs are exchange traded products, liquidity comes into play. And liquidity in this case, it basically measures how easy or difficult it is to buy or sell the ETF quickly without affecting its price. So in general, investors should go for ETFs with higher liquidity because it allows them to react swiftly to changing market conditions. And you do not want to be in a situation whereby you want to get out of an ETF, but you are stuck with it because you can't find, anyone to take it off your hands. Okay, and another question that I generally receive from investors is that, you talk about ETFs, you talk about unit trust. So which one is better? Active and passive, which one is better? For me, my reply to them is always this. Why do you have to choose one when you can actually enjoy the benefits of both active and passive strategies? Now, you don't have to see your portfolio as 100% unit trust or 100% ETF portfolio. It doesn't always have to be the case because it is my personal belief that there is no single investment product out there in the world right now that can do everything for our portfolios. In certain markets, in certain sectors, I think active strategies will make sense. And whereas in other markets, I think passive strategies will make sense. So the rule of thumb for us is that if we are able to find a good and reliable active strategy that has a very good track record of outperforming the market, then by and large, we will always choose active. But in certain markets whereby it is so difficult to find strategies that can outperform the market, we are not so inclined to pay the higher management fees, and we are more inclined to fall back on passive strategies. We just get the market returns at a very low management cost. So passive versus active. I think it really boils down to the individual market that you are looking at. I think it is also imperative that investors recognize the benefits of both active and passive, and you seek to achieve the right balance of both active and passive strategies inside your investment portfolios. Now, after you select the right products for your investment portfolio, the last step is to review your portfolio regularly and to do a rebalancing if necessary. So what do you review? You review your asset allocation, and if you have certain market views, like I said just now, if you have certain strong market views, that you want to reflect inside your asset allocation, it is also okay to adjust your portfolio allocations. In terms of the products that you select for your portfolio, over time, you may find that some of the products that you have selected for your portfolio, it may not be suitable, or other credible alternatives in the marketplace out there may be available. So in such cases, you may want to switch products for your portfolios. And also, last thing, I think it is also important that investors do a rebalancing when their portfolio allocations deviate substantially from their initial target. So when they realize that their portfolios are drifting from their intended target allocations, then this will actually be the cue for investors to do a rebalancing of their portfolios. Now, before I move on to talk about, how you can generate income, I just wanted to say also that, since today we're talking about building a portfolio, how to invest your kids' AngPao money, I guess one of the questions that you guys might have is, how do I build an investment portfolio for my kids? So my answer to that, I think this is my point of view. My answer to that really is, I think there is no difference between how you build a portfolio for yourself and your kids. And I think the difference between you and your kids is that the two of you have very different time horizons. So personally, when I am building a portfolio for my kid who is actually very young, I see him as an aggressive investor with a very long investment horizon and who is able to stomach short-term market volatility. So I will build his portfolio based on the profile of an aggressive investor. And I will simply just adopt the very same the mindset, or rather the very same framework that I use for my own portfolio construction, and I will apply it to his investment portfolio. So I think the way you construct investment portfolios for yourself and your kids, I don't think that's any big difference. I think some parents over here may disagree, but for me personally, I don't think there's a big difference. Okay, and on the next point, how do I build a portfolio that generates regular income? It is actually not too different from the 4-step process that I just showed everyone. Essentially, what you need to do is you need to make certain fine-tunes, certain tweaks to the 4-step portfolio construction process in order to ensure that this portfolio generates a regular income for you. So some of the suggested tweaks that you can make to the portfolio construction process is in steps 2 and 3. So for steps 2, when you are looking at your intra-asset allocation, when you are deciding which markets that you want to invest in, you might want to consider including markets or sectors that typically generate a high level of income. So REITs is definitely one sector that you need to have inside your portfolio if you want to generate a regular stream of income from your investments. And also in step 3, in terms of your product selection, essentially you want to select ETFs or unit trusts that are focused on dividend stocks. And also for unit trusts especially, you should also go for the distribution share classes instead of the accumulation share class. Now, for step 2, I think there are a couple of ways to change the intra-asset allocation. So again, I go back to the equity market allocation that I showed everyone just now. So I think one of the things that you should take out from this equity market allocation is to take out the digital economy from the equity market allocation, because digital economy stocks, they are generally growth oriented and a lot of them don't pay dividends. So essentially, you need to take them out of your portfolio if you want to craft an allocation that gives you a high level of income. So digital economy, you should consider taking it out. And also if you're uncomfortable with emerging markets, especially Latin America and EMEA, markets that are high risk, volatile, and are generally more susceptible to dividend cuts, you can consider removing them from the suggested equity market allocation, and then you put in sectors and markets that generally generate a high level of income. So in my slides over here, I think REITs is something that could potentially generate high income for investors. So our initial equity market allocation could eventually end up something like this. So you have 25 allocation each to Asia ex Japan, US, Europe. You have a 5% allocation to Japan and a 20% allocation to REITs. Again, these percentages are not a hard and fast rule. This is just a suggested way of how you can potentially tweak your intra-asset allocation to incorporate sectors that typically pay a high level of income. And also in terms of the product selection, you generally want to select funds that are focused on dividend stocks. So for example, if you want to get exposure to Asia ex Japan, for example, instead of choosing a more plain vanilla shoulder Asian growth, you can also go for something like an active strategy that is focused on dividends, like the First State Diva. And if you decide to go passive, if you decide to use ETFs for exposure to these markets, then of course for Asia ex Japan, instead of just using the iShares MSCI Asia ex Japan, you can consider using the iShares Asia Pac Dividend ETF instead. So the usage of dividend paying strategies, I think that's another potential fine tuning that you can make to your overall portfolio. And last but not least, when you're choosing products, please remember that you should always opt for distribution share classes because there are some funds, the same exact fund actually has both distribution and accumulation share classes. The United SGD fund, a very popular fund on our platform, I think that's a very good example. It comes with both accumulation and distribution share classes. So if you want a regular payout from investments, essentially you want to choose the one that is that offers distribution and not the one that is not the one that is accumulation instead. Okay, so potential fine tunings to make sure that your investments can generate a regular stream of income. Does everyone need to make these fine tunings to generate income? I think ultimately this really depends on your own individual circumstances. If you don't need regular income, I mean, for my boy especially, I don't think he needs a regular stream of income. So because of that, I generally don't do the fine tuning for him. I don't incorporate dividend paying strategies into his overall asset allocation. Personally as well, I also don't have a need for, or rather, I don't have a desire for a regular stream of income from my investments. So I also don't do that. But if you desire to have a monthly stream of income, I think these are the potential things that you can do to ensure that your investments pay you a regular stream of income. And last but not least, for investors who look at my slides and then think that, okay, this is not something that I want to do, or this is not something that, I really don't have the time to build my own portfolio, then of course, at FSM, we do have a solution for you. And this is actually our FSM Managed Portfolios service, which we call MAPS. So MAPS is essentially a portfolio management service that helps you to build your portfolio. We also help you to monitor the performance of your portfolio. And if there is a need to rebalance your portfolio, we will also help you to rebalance your portfolios. So essentially, we are taking care of the day-to-day management of your portfolio and are also keeping in mind your risk tolerance. And I think one very special characteristic of FSM MAPS is that it is very accessible to all investors because you don't need a large upfront capital in order to invest in MAPS, because with just as little as $500 a month in an RSP, you can actually gain access to a very diversified portfolio of international equities, not just international equities, but also to all the major bond markets as well. And we have different portfolios for different risk profiles, and we actually do have a range of 5 different portfolios, from the conservative portfolios to the aggressive portfolios. So if you are somebody who has a relatively short investment horizon, or if you generally want to to be a bit more conservative with your investments, then of course we have the conservative and moderately conservative portfolios that you can consider. One thing that I would like to highlight on this particular slide is this target return. So this target return is not actually the guaranteed returns. These returns are actually not guaranteed. And these returns are actually calculated using back-tested data for global equities and bonds. And these numbers are actually there to give you an idea of roughly how much of a return can you reasonably expect from each different risk profile, from each portfolios of different risk profiles. So the more conservative ones will, of course, have a lower risk, but at the same time, they also come with a lower expected return. So for conservative and moderately conservative, the kind of returns that you should be expecting from this kind of portfolios is about 3.5 and 5% respectively. But if you think that these returns are a bit too low for you, and you think that you can afford to take on a bit more risk, then of course we have the balanced, moderately aggressive, as well as aggressive portfolios that you can consider. So target returns 6.5, 8, and 9.5% respectively. But bearing in mind also that these higher expected returns also come with higher risk as well. So for your kids, if you think that they are, if they have a long investment horizon, then of course you can actually just park their AngPao monies into the aggressive portfolios. But if you just want to preserve their capital, then of course going for something that's more conservative will be more appropriate for yourself and your kids. Okay, and of course, any discussion on our MAPS managed portfolios, it will not be complete if I don't show you guys how we have performed so far. So MAPS was actually incepted in December 2016, and since then we have delivered annualized returns of between 4% for the conservative portfolios to about close to 10% for our aggressive portfolios. So at this moment, we are still lagging behind by our benchmarks by a bit, but we have been catching up. And especially in 2020, we have managed to outpace our benchmarks by quite a fair bit, especially if you look at the 1-year returns. Our aggressive portfolio for the past 1 year has generated returns of more than 20%. And this has actually outpaced our benchmark by quite a fair bit. Okay, besides that, I just want to highlight also that we have income portfolios as well. So our income portfolios are really designed to cater to the income needs of investors. So like I said just now, if you don't have a need for income, you can just go for the growth portfolios. But if you desire to receive income from your underlying investments, then of course we have the income portfolios that you can consider as well. And our income portfolios have actually generated annualized returns of between 3.5% to about 8.8% since inception after fees. And also, again, similar to our growth portfolios, we have been catching up with our benchmarks. And in the year 2020, we have actually captured quite a lot of upside from the very strong run-up in global equity markets. Okay, so I just want to sum up today with a few key points that we can all take away. So I think the main takeaway for investors is really the very systematic and very simple 4-step process that I have showed everyone today. So I think this is a very simple framework that you can adopt for yourself. And like I said also, please do not take it as the gospel truth. There are many ways to do your portfolio construction. This is just one of the ways, but if you're not sure where to begin, you can use this as a starting point, and then you make adjustments to it based on your own individual financial needs. And also, if you want to receive regular income from your investments, I have also suggested a couple of fine-tuning that you can do to this 4-step process. And last but not least, I think for those people who just want somebody to look after your portfolios, at FSMOne, we do have a solution for that. And that solution is our managed portfolios MAPS solutions. Okay, so with that, I end my sharing today. Thank you so much for tuning in. And I think now we have a bit of time for Q&A.
Right, thank you, Wei Ren, and thank you to all speakers this evening for all of your presentations. So to our viewers, well, thank you for also being with us and listening. If you have any questions from here on, feel free to put them into the Q&A box. If you see a question you like, you can upvote it as well, and then we will then send these questions on to our speakers here. So first up, this is one of the questions that were asked. So he's basically asking, how do I teach my kid that investing and personal finances is important? And are there any success stories to share? Perhaps Bernard, you'd like to kick us off. Are there any stories you can share? And how did you go about teaching your kids about personal finance and investing?
Thank you. This is a very interesting part. In fact, just when I saw the question, 2 scenarios came across over to my mind. I'll just use these 2 examples of these 2 families that did something that really intrigued me and I thought was good. So the first part was at pre-COVID days. I'm sure all of us will know that there's a flag days. That means every Saturday, where you go out Saturday morning, you will see people with containers that will be selling a sticker. Yeah, it's called a flag day. Now, of course, recently there's no more. And this family, what they do is that every Saturday, the mother will put 1 bunch of coins Yeah, and will just bring that child out in the morning to go for breakfast and pass a bunch of coin over to that child. And the child is enthusiastic wherever that he sees someone selling flags, yeah, for donation, will pass him to ask him to drop a certain coin inside. And he's just very happy doing that, not knowing what that behavior was. Of course, that child has become almost a young adult right now. I talk to her very often. Many years back, she's right now, they started to record this philanthropic act, and that actually strikes her. And that was really, really young when she actually started that. So part of the answer to the question, it can be really as young as what you think can be done and through daily activities. Yeah, so this is just the first part of that philanthropic act and understanding the purpose of money. The second part was just about entrepreneurship. And again, a very young child. And what the mother did was to ask her to go around. So this is something that schools don't like. Yeah, there were some small little toys that the child and the friends liked and enjoyed. So she just ordered a bunch of toy, those whatever. It's there's a spinner. I forgot what's the term for that, for autism related spinner, and order a bunch across from Taobao or Lazada, whichever it was. And the child actually went around school selling it. I know schools don't like this. It's a wrong behavior. But entrepreneurship is something that the very first way that you can teach a child about earning money and losing money. Okay, so that was probably, I think, P2 or P3 for that client of mine. So I use this as a very simple example. I do encourage you guys, explore means and ways across your children. You never get it right the first time round, but they will start to understand the purpose of money. Thank you.
Thank you, Bernard. Florence, do you have any also like similar success stories to share, be it on the home front or whether it's through the marketing efforts that eSpring does?
So I have slightly older children. So I have 2 teenagers as well, and my elder daughter is 19. So I do invest for them, and they have slightly different, deliberately, we've made slightly different portfolios for the 2 of them. And I think when they are personally invested, and because they also have an age where you can have conversations with them, they are very interested in what's happening to their portfolios, and they want to understand why is theirs not going up as much as it is. And and then when you can have conversations, and it's also very good, I think, when they start to lose money and then they understand what risk is as well. So I think those are very important lessons to instill in a child when they are young, when they have less money to lose than and as an adult when they can make big investment decisions. So I think being personally invested helps. When I was during Chinese New Year, I shared a story on my LinkedIn, and somebody wrote back and said, what they did was, instead of giving their child a weekly allowance, they gave their child a monthly allowance, so that encourages them to budget. And then what they did also for that child was, with the permission, because of COVID and there was a lot of news on vaccines and all that, they put some of that child's money into a healthcare fund. So I think if we take daily examples and we talk to our kids about it, I think those are little lessons, and they get that interest and a bit of understanding. So for example, if your child likes to watch TikTok videos, you can talk to them about the company that owns TikTok. And so I think there's little avenues that you can use to try to stir up their interest in investing, and then move on from there.
Thank you, Florence. Yeah, that's certainly an interesting way to get people to think a little bit, to get children to think a little bit more about investing. I noticed also you mentioned that for your daughters, the portfolios are constructed slightly differently. Will you be able to share, is there something perhaps our viewers could take home from, could learn from about why you might have constructed them that way?
So I agree with Wei Ren just now when he mentioned that for his child who's very young, that the portfolio will be very aggressive, because children who are young, they have the advantage of a very long time horizon. So we tend to pick quite aggressive investments for the children. But while we may, so we pick specific stocks, and while we may like a certain theme, for example, technology, we may pick that there are a few technology stocks, and you just say that, I will pick one and the other one I put in the other person's portfolio, the other child's portfolio. And it's more of saying, I think it's more of diversifying your bets at the same time, and also trying to help them understand, because we do have dinner conversations about what's happening to my stock, why is it like this, and what's happening. And that actually, I think, helps them to understand the world of investment a little better. Yeah, and what drives market movements.
Right. Thank you, Florence. So speaking of market movements, we all know markets have times of boom and sometimes times of bust as well. People often think buy low, sell high as a means to success. Perhaps I direct the next question to Weiren, also taking a question from our Q&A section. Basically, this person is asking, should I wait for a good time to enter the market? So I suppose waiting for maybe some kind of correction, some kind of pullback. So should this person wait for a good time to enter the markets when investing for my kids? And perhaps how young can they start to learn? Maybe Weiren could chime in on that bit.
Okay, for the second part of the question, I'm not sure and I'm in a position to answer that. My kid is 8 months old and I'm a first-time parent. So I think Bernard and Florence probably will have the expertise in that. But I'll just take the first part of the question. Should I wait for a good time to enter the markets? My view on that is I don't think there's ever a good time or a perfect time to enter the market, because ultimately it's about time in the market rather than timing the market. So, in this current investment climate, people are saying that, oh, there is a bubble in equity markets. Maybe now's not a good time to go in because there could potentially be a sell-off coming. But if you look at the way markets work, expensive markets, they can remain expensive for a long time. And by staying out of the markets, you are actually missing out on the opportunity to get a decent return on your investments. So for me personally, I'm always invested across all market cycles, whether it's a good time or a bad time, whether markets are rallying or declining. So generally what I do is I reduce my equity exposure if I think that markets are a bit expensive. When markets crash, in 2020, when a black swan event comes, I think there is also the cue for me to go in to increase a bit more exposure to equity markets. But of course, if you have been outside of the market and right now you are thinking whether to go in or not, I think one of the ways that you can potentially go in to spread out your risk is to consider things like RSP, consider things like dollar cost averaging. So you slowly go into the market rather than, one lump sum go in and, the next day the market crashes. So this could potentially happen. And if you want to reduce the risk, if you don't want to be in that situation, then of course, I think one way to do it is to, spread out your investment across a period of time, and then you slowly go in. And I would personally go for, diversified vehicles. So I personally am invested in MAPS myself as an employee of iFast. So because I think it's very diversified and it gives me, exposure to many different markets out there in the world. So I think there's never a good time. In short, I think you might want to start investing, but of course, if you have been outside of the market, I think RSP is something that you could potentially consider. I think for the second part of the question, maybe Bernard and Florence can add some color to it.
Nothing much from me. The only thing is, let's start off with very simple activities like the selling flag one that I mentioned just now. They can really just be as young as 2-3 years old.
And Florence, perhaps in your own personal experience, when did you start your children off on investing?
Probably when they reach secondary school. That's when they can understand a little bit better and you have a more meaningful conversations. Yeah, so that's probably the time that we started more seriously talking to them about investing. And I think as part of our money parenting initiative, children learn from their parents. And so if you are an investor yourself, I think they are more open actually to considering investments than if you had parents who actually don't invest at all. And then they might be a bit more cautious and wary of that. So I think we do ourselves set a good example.
Right, wonderful. Thanks, Florence. On another parenting related note, perhaps we can also go another round again. This person's asking, I receive AngPaos and gifts for my newborn. How should I allocate this amount for investments? Should I, put that all into investments, or is there any recommended way, perhaps, of distributing that across savings, insurance, or endowments? I suppose it's a little bit of a financial planning matter. Maybe Bernard, you'd like to kick us off on this?
Yes, I will actually split that across between a capital preservation instrument, and what we mean by capital preservations will be some form of savings, or even I think I use an endowment as a very simple example. But please bear in mind, do not overuse all these capital preservation instruments like savings and endowments, because we all know that all these instruments do not grow in size. They will not grow based on the market movements, and that's where investments will come in. Yeah, so of course the other half of it, that's where sometimes the amount may not be big, and I leverage it upon some portfolios that we have created. Weiren himself runs a wonderful portfolio that I use a lot. I think just now we talked about maps as well. So to grow the portfolio, simply done, the main thing we want to be concerned with is that the monthly amount that the child may have or that we may have may not be big. It might be probably $200, $300 every month. For us to meaningfully get it involved into stocks, although we do have a big stocks portfolio across with our client, it is going to be very difficult. So to leverage upon it, it might be actually even using active tools like unit trust or even portfolios. So I will combine these two together. Yeah, there must be capital preservation, but do not only use capital preservation. Do not only save your money in the bank. That is one of the big pitfalls that a lot of time the clients may have.
And is there a certain percentage, would you say? Is there any kind of range that you might recommend to clients?
I wouldn't use a percentage per se, but things like example, capital preservation tools like endowments, I only start them in the very early stage of the child's life. Can be example 1, 2 years old, and it may just be a small amount of 200-300, and then beyond there, where the child gets a little bit older, which also means that the time towards the education timeline becomes shorter and shorter, then all those saving instruments may not make sense anymore already, because you only have that very short 3, 5, or even 10 years towards your university degree. So only the first few years we will start. It can be simply $200 or $300. That's very affordable. And then the next few years onwards, all will be using an investment instrument. So instead of using a percentage, I will choose to cut it across based on timeline and how many years towards the final goal, like example, the education goal. Of course, there is a lot of art and science behind there. We really need to have a quick consultation in order to determine anything.
Certainly. Thanks, Bernard. Anything from Weiren or Florence? Is there anything that you found particularly helpful in this area about how you plan your finances for your children?
I would only mention that within the investment portion, that it would be, as Bernard alluded to, very growthy or equity bias, simply because time is on the side of the child and they can tolerate volatility, and there's very little need, I think, to tap onto or liquidate the investments.
And for myself personally, my 8-month-old kid also received AngPaos during the Chinese New Year. And what I did with the AngPaos is to immediately ask my wife to open a beneficiary account with FSM and start to invest the monies. So right now, it's 100% of the AngPao monies in investments. But having said that, it's actually because I am influenced by my everyday work. I look at investments every day. So naturally, my first inclination is to put everything into investments first. But I would also say that very objectively, this is not the ideal situation. So I would go back to what Bernard has said just now. I think we should always look at our kids' finances, not just from an investment perspective, but from a more financial planning perspective. So I'm of course not the right person to ask. So if you need some advice on how to go about, looking at finances from a more wholesome perspective, then of course, consulting a financial advisor, I think that will be a good thing to do as well.
So thank you for that, Weiren. So perhaps a little bit more specifically about investments for children. Since some of our viewers probably have children who are probably younger and have a longer time horizon, as you mentioned just now, maybe you could remind some of the listeners again what kind of products they could go for. And perhaps Florence, you could also chime in after that. Maybe what kind of products have you used? Do you see as being helpful for people with a longer time horizon?
Okay, so I'll start off first. I think first and foremost, based on the available investment products out there are many different things that you can choose from. You can buy individual stocks, individual bonds, ETF, unit trust. But of course, for in this viewer's case, his kid is very young, long time horizon, which also means that he is also in a similar situation as me. Our kids have long time horizons, and they are probably can be considered aggressive investors. So for that, I would recommend going into the more aggressive investment products like your stocks. But of course, if you want to invest in individual stocks, you can, but this is not something that I will consider because individual stocks requires a bit more time, a bit more effort, because you want to research. You have to research on individual companies, and if you buy individual stocks, you run company-specific risk, and there is the possibility that you could lose your investments in that particular company that you're invested in, which is why I am always more inclined to go for more diversified vehicles. When I look at stock markets, when I invest in stock markets, I essentially want to go for either ETFs or I go for unit trust. And this will be the two primarily investment products that I generally go for.
And Florence, similarly, what sort of products perhaps for a longer time horizon have you found helpful for your children? Would you like to share with our viewers about?
So if you do not have the expertise or the expertise or the time and resources to research into stocks, agree with Weiren. So in my family's case, probably a little different because my husband used to be a former portfolio manager, and so that's the expertise there. But I do think equity funds are potentially actively managed equity funds, for example, can help generate returns, long-term returns, especially those exposed to very long-term structural themes that we like. So, ESG, technology, I think these are some things that children's portfolios should have exposures to. So yeah, something like that to consider.
Right, thank you, Florence. Thank you again to all our speakers for taking the various questions from the viewers here tonight. Perhaps as we come toward the close, maybe Bernard, do you have any last words just as an overall financial planning thought for our viewers? And maybe could you remind people again how they may reach you, especially the ones who may have more questions about perhaps a more holistic kind of financial planning?
Yes, a few things I saw through the Q&A. I think just now, especially on the investment fronts, we really should consider using a ETF portfolio across our clients, especially for a very long-term perspective. So that's how I plan things across for some families. One of the key reasons might really be because of the cost and the active and passive process. So do consider about a passive, a pure passive approach, which is what I construct across with clients. So that's the very first part. The other part that I saw through the Q&A was this part about there's as many questions regarding a beneficiary account. And I do realize that one key part about financial planning, which we didn't intend to discuss over here, but which is actually the part about estate distribution. That means when the parents are no longer around, how will the money be passed on over to the children? So there is still a need amidst all this investment planning that we've been running across for clients. The important part is that the will for the parent must still be done. And it's not just about handing the money over, but we just need to determine who will be the guardian for the child when we are no longer around. Yeah, so these are the two parts I thought we should bring up just to trigger. Of course, if you guys want to look for me, you can find me on LinkedIn. Just look for Bernard Chan iFast. You will see me. Yeah. Thank you.
Okay.
Thanks.
All right. Thank you, Bernard. Thank you, Aaron, and thank you, Florence. That's all we have for tonight. So thank you to all viewers for tuning in. If you'd like more of such sessions, stay tuned to FSMOne.com and also pay attention to our e-newsletters that we send out on a daily basis. So thank you, everyone. Have a good evening. Stay safe.
Thank you.